Hi! In this video, let's review some financial ratios to evaluate a firm's profitability. A widely used profitability ratio is the return on assets or ROA. To get this ratio, we divide a firm's net income by the total value of its assets. In a nutshell, for each dollar the firm owns in the form of assets, it tells us how many dollars the firm is generating in net income. Another profitability ratio is the return on equity or ROE. In this case, we divide the net income by shareholders' equity. This ratio is most relevant for investors. It captures your gains as a percentage of the amount you have invested in the shares of a firm. Finally, we may also measure a firm's profitability through the profit margin. In this ratio, we divide the net income by a firm's total revenue. If you are a manager of a company, this is one of the most important ratios to pay attention to. For each dollar you sell, this ratio captures how much are your gains. The basic earnings power ratio is calculated dividing the earnings before interest and taxes by the total value of the assets of a firm. But when is this ratio helpful? I will share one example of a situation where this ratio might be quite helpful. Let's assume you are planning to buy a startup company. The business seems promising and everyone in town is talking about their brand and products. For some reason, the profit margin, the ROA, and the ROE all seem too low. However, you take a look at the financial ratios capturing leverage, and you realize that the firm has built up a substantial amount of debt over the previous years. All three ROA, ROE, and profit margin are calculated from the net income. If a firm is dealing with significant cost of debt in the form of interest expenses, the net income may be driven down. Let's assume you are planning to eliminate the firm's debt after you buy it. In that case, interest expenses will be gone. You go back to the negotiation table, and you ask for their basic earnings power ratio. In contrast to ROA, you do not consider net income, but instead, you look at the earnings before paying your interest expenses and taxes. That is the EBIT. You then divide the EBIT by the total value of the firm's assets. In the case of the startup you are buying, you learn the basic earnings power ratio is 8.5%. At that point, you acknowledge that the firm is inherently profitable. However, its profitability is being eroded by interest expenses. Moreover, you may be interested in evaluating a hypothetical scenario where you pay off all debt, and then you recalculate the profit margin, ROE, and ROA. You may have also heard about the term earnings per share. Keep in mind that the net income of a business is the total value of gains after taxes are paid. If you divide the net income by the total number of shares outstanding, you will calculate how many dollars in the form of gains you should receive if you own one share of that business. Let's assume a firm generates a net income of $1 million. This firm has 1 million shares outstanding. In theory, the holder of each share should receive a $1 check. However, a firm may decide to pay only 50 cents of the earnings per share to the shareholders. Hence, 50% of the earnings per share. This 50% figure is referred to as payout ratio, which is the dividends paid to the holder of each share of the firm divided by the total earnings per share the business attained. What happens to the other 50 since the firm does not distribute to shareholders? You are right. The firm will reinvest it. The managers could expand the size of a manufacturing plant, or they could buy new equipment, or they could build a cushion of precautionary cash in their bank. Finally, you may have heard about the popular P/E ratio, or more properly price to earnings ratio. Its calculation is quite simple. You divide the price per share by the earnings per share. This ratio captures how many dollars shareholders are paying for each dollar of earnings they are attaining. The P/E ratio is extremely helpful, and as you continue learning about finance, you will use it in multiple ways. However, let me focus on one potential dimension that might be useful. Let's think of ABC Corp. This is a hypothetical firm with a P/E ratio which has been increasing consistently every year. Why is the P/E ratio increasing? If this is the case, it means the price is increasing but the earnings per share are not increasing, or at least they are increasing at a slower speed. Hence, investors are paying a higher price for each dollar of earnings per share the firm is attaining. This is not necessarily a negative sign. For example, if a firm is investing significantly in R&D, an increasing PE ratio may be capturing that investors are aware the firm is not generating higher earnings as of now, but they expect this will happen substantially in the future. However, if this is the case for any firm, you may want to evaluate it carefully. Great! So we have reached the end of this video. Thanks so much for your attention. Please contact your instructor if you have any doubts or questions. Keep up the good work.